Okay, so our last session will be talking about sales variances. Particularly, we are going to look at the basic sales variances, and then we are going to look at the subcomponents of the sales volume variance. Remember that when you're a company and you have more than one product, definitely you will sell them in mixes, right? So let's say I sell Pepsodent and paste, a Pepsodent and then brush. I may mix them in some quantities and sell them. So it may sales definitely has a mix variance. That is a change in the quantities, and each of the change in the mix of the product will result in what a different sort of what quantity. Not so. So that is what I want you to look at. So just like mix and yield, sales mix is also the same. Now, when you look at the sales variance itself, is two types. Okay, so we have the volume variance and we have the price variance, right? Now, volume can actually be broken down into sub-variances. So only the quantity variance that can be sub-broken down. Just like material can be broken into mix and yield, labor can also be broken into mix and yield. That is in the quantity can be broken into mix and yield. It's still the same as what you did for material. But when it comes to sales, first of all, let's get the sales volume variance. Now, remember that when it comes to volume, is the change in your volume. So when it comes to sales volume variance, it is actually the difference in your quantity sold. So this one is actually what? Your actual quantity minus what? Your standard quantity, all times standard profit. Now, remember that if a business will be successful, it depends on the contribution that they have, or your if you are using a marginal costing process, right, or a marginal costing system, then your contribution determines your volume, or your volume determines your contribution. It goes together. The higher your profit, it depends on your contribution and your volume, or your profit if you are using standard costing or standard absorption costing system. So for volume, we always multiply by standard profit. But when it comes to price, you are looking at the change in price, how actual price should differ from what your standard price. But here, we measure it based on your actual quantity. So how a change in the actual price and standard price, I get in it, affects your actual quantity. Okay, so at your actual quantity, that is what the price variance. So this is how you deal with it if a question is actually what given. But usually what ICO used to stress you is this standard profit thing. I get it. So the standard profit will mostly require a working. And I think this question requires us to work for the standard what? Profit. And that's what we are going to do. I get it. To get the basics sales variances. Okay, so you see they said we should find sales profit margin variance and then sales volume profit margin. So they've asked us for all that. Now the volume variance can be sub-broken just like the material into sub-components, which you call the sales quantity variance, which is like yield if you are doing material, and sales mix variance. Okay, so just like we did mix and yield is the same approach. Okay, so you just turn it the other way around. You see, the same way, I just want to help you so that you remember it. So the same way, remember I told you do SQ, AQ, and AQ. I never change my approaches. So I have SM, SM, and AM. You remember? So with this one, you go this way. For sales, you go the other way. You turn it upside down, right? So sales, I will rather start with what? AQ, because I'm going this way, to start with AQ, AM, not so. I'm going this way, AQ, SM, and SQ, SM, right? So now that I know this, I know that between this and this, the difference is in AM/SM. So this is the sales mix. And between this and this, the difference is in what? The AQ, SQ. So this is the sales quantity, right? So you see, it's just the same as what we did before. If you adopt it this way, you get the relationship between the two. So now that means if I'm doing sales quantity variance, I can rewrite it as what? AQ SM minus SQ SM, also all times standard profits. So sales is on standard profit, not standard price. And when it comes to what the sales mix, just like the other mix, you are doing it in the opposite direction, right? That gives us what? AQAM minus AQSM. Also, all times your standard profit. So the standard profit is where the issue is, and that's what you always have to calculate. So as usual, you are going to find these three items. But first of all, the most important thing is the standard profit, and that is what most questions will confuse you or will waste your time to do. So let's look at this question. And this will tell us how to determine what our standard profit. Even the standard profit is 3 marks. They said we should calculate our standard profit. And standard profit means we must have material, we must have labor, we must have what overheads, right? So I'll use O, G, and D for oil pump, gas pump, and then diesel pump, right? So I think to get standard profit, we need sales minus what? The cost. So we have selling price. So you can get your selling price here. Selling price, we have 91, we have 97.5, and then we have 117. No, so then we have direct material. Direct material, we have 35 CDs, 10 pesos, 26 CDs, 65 pesos, 26 CDs, 65 pesos, and 31 CDs, 52 pesos, right? So now we need direct labor. Now we need direct labor, but direct labor has been given per hour and the number of hours that we have. Okay, so the same way, we can actually get the figures for direct labor. So direct labor, when we take O for direct labor, it says we are paying 6.5, but we are using 3.25 hours. Now, so for O, when we take gas pump, it says we are being paid 6.5, but we are working 5.2 hours, right? We can see it from here, the hours of labor. And when we take diesel pump, all labor is paid 6.5 per hour, but they are working 4.55 hours, right? So we can easily get the direct labor just like we've seen here. So we have 6.5 by 3.25 hours. That means direct labor should be what? 21 CDs, 13 pesos. Then 6.5 by 5.2. That gives us 33 CDs, 80 pesos. 33 CDs, 80 pesos. Then the last one, 6.5 by 4.55. And that gives us 29 CDs, 58 pesos. 29 CDs, 58 pesos. Okay, so that is what we have. Now they've given us machine hours per unit and they gave us fixed overhead. So it says the total fixed overhead for the last period was estimated in the budget to be 526,500 and was absorbed on machine hour basis. That means we have overheads, right? Since we are using a standard marginal costing systems, are you getting it? Was it marginal costing? No, they didn't tell us. They said we use an absorption costing system. That means you have to absorb fixed overheads. And one thing I always tell students to do is to find your OAR. So your OAR, or the standard rate for fixed overhead, is your total budgeted overheads over your total budgeted absorption basis. But in this question, it says we should use machine hours. Okay, so machine hours is what we need. So what's our total overheads, our total budgeted overheads? Per this question, they are saying that our estimated fixed overhead is 526,500, right? So that has been given. But what is our total machine hours? Total budgeted machine hours. Total budgeted machine hours. So our total budgeted machine hours, we need our machine hours. Now it tells us that, okay, so we have machine hours here per unit. That is per unit, but we need for all the units. So if we take oil pump, we are using what? 1.95 machine hours. But how many units were being produced? 10,000 units were produced from the data that I've highlighted, right? So we get the machine hours. When it comes to gas pump, the same way we are using what? 3.9 hours at 13,000 units. The same thing for diesel pump. We have what? 5.2 hours. Also going for what? 9,000 units, right? So in that case, what then do we have? So we have 1.95 by 10,000. That means we have 19,500 machine hours. Then you have 3.9 hours by 13,000. And that gives us 50,700 hours. Then you have 5.2 by 9,000 hours. By 9,000 units, sorry, you have 46,800 machine hours. Now, when you put this together, you get your total machine hours. Total machine hours. So if you are giving your total machine hours, then you have 19,500 plus 5,700 hours plus 46,800 hours. That means you end up with 117,000 hours overall. So now that you have your 117,000 hours overall, that means you can take this 526 and divide by this to get your OAR, right? So that means my OAR will be my 526,500 divided by 117,000 machine hours. Okay, so what then do we get? So we have 526,500 divided by 117,000 machine hours. And that gives us 4 cedis 50 pesos per hour per machine hour. Okay. So for every machine hour that is used, we incur 4 cedi 50 pesos for overhead. But then we can ask ourselves, then how many hours were used for each unit? How many hours per unit? And we have actually been given the machine hours per unit. I've highlighted them. That means if I take oil pump, right? If I want to get the overheads, just like I did in the question, I think, do we have enough space to do the overheads? Yes, we can do. So we can say production overheads. We've got the rate, right? So when you take oil pump, it was 4 cedis 50 pesos per hour. But how many hours? We can see it's 1.95 hours for this guy. When we come to gas pump, how many hours? It's 4.5, but gas pump we use what 3.9 hours. How many hours for diesel pump? That gives us 4.5, which is the overhead absorption rate times 5.2 hours, right? So we can get the figure straightforward. This 4.5 by 1.95. That gives us 8 cedis, 78 pesos. Then you have 4.5 by 3.9. That gives us 17 cedis, 55 pesos. Then you have the last one, 4.5 by 5.2. And that gives us 23.4 pesos. Okay. So that is our overheads. Now, if we take all these costs, that's the material and the labor and the overheads from the selling price, then we should get the standard profit. And that's the main thing you need for your sales volume variance, right? So your standard profit is the most important thing you need. But note, in marginal costing, your standard profit is the contribution because we don't have fixed cost per unit in marginal costing. So it ends at your contribution. So you have 35.1 minus 21.13 minus 8.78. So that ends up with a standard profit of 5 cedis 19 pesos, 5.19. Then we go to the next one. We have 97.5 minus 26.65 minus 33.8 minus 17.55. So we get the profit for this guy to be 19 cedis 50 pesos, right? As a standard profit. Then when we come to the last one is 117 minus our 31.52 minus our 29.58 minus our 23.4. And that gives us 32 cedis 50 pesos for the standard profits, 32 cedis 50 pesos. Now that we have what we need, we just need to go and we have standard profit now. so we can get the variances that we need based on the quantities that we need. Is that okay? So what quantities did we expect? So we have our budgeted units, and we should have our actual units. So actual units have been given here, and then budgeted units have also been given. So if I want to do the normal sales variance, that is without the mix and the yield, I can do it still. Okay, I can do the normal sales variance. So let's say I want to do my normal sales variances, right? Which is the volume and the price. So first I will start with sales price. And I know that you all know from what I did earlier that sales price is the difference in price. So your actual price minus what? Your budgeted price or your standard price times your actual quantity. And per this question, you ask yourself, where do I have my actual quantity in the question? Where do I have my actual quantity in the question? And when you look here, the data here says actual production and sale. So this is the actual quantity. And you can see your actual price here. You can see your standard price at the top. So straightforward, if we take oil pump, also oil pump, my sales price variance is going to be what? The price for oil pump, actual price for oil pump was 94 cedis, 25 pesos, right? 94 cedis, 25 pesos. We can see it from here, 94.25 minus the budgeted or standard price, which was 91 cedis, all times the actual quantity, which was 9,500 units, right? So we can see it from here. So this gives us a favorable variance, 94.25 minus 91, all by 9,500. That means you have what? 30,875 favorable, right? For oil pump. What about gas pump? Gas pump, the actual price for gas pump from the actual selling price units down here. And also the figures we can see down here, actual selling price was 100.75. So this gives us 100.75 minus the budget, which you can see from the standard information here is 97 cedis, 50 pesos, 97.5, right? 97.5, all at how many units? 13,500 actual units were found down here where I picked the actual figures. You can see it from down here. Okay, so 13.5. So that is what we have. So you have 100.75 minus 97.5, all at 13,500. And that gives us 43,875. 43,875. Favorable again. Okay, 5. Favorable. Now, when it comes to diesel pump, let's try and work it out and see. Diesel pump is actually sold for 123.50 pesos, but when you look at the standard, it's 117. So this one, the actual quantity was 85. This also gives us a favorable variance again, which is 123.5 minus 117, all times 85. And that gives us 55,250 favorable. So when you add all that, you should get your total sales price variance, right? Which is our total sales price variance. When you add all, you should get your total sales price variance, which is 30,875 plus 43,875 43,875 plus 55,250. That gives us 130,000 favorable for price. 130,000 favorable for price. Now, when we want to do sales volume, actual sales volume, not sales quantity and sales mix, to get your actual sales volume, you all know that sales volume is calculated as the difference between what our actual quantity sold minus what our budgeted quantity or standard quantity times, because we are in total, we are doing total quantities. That's why you can use budgeted quantity, right? All times our standard profit. And we have already calculated the standard profit for each of our items. So if I take oil pump, I know that my actual quantity, we can see it from down there where we have actual information as 9,500 minus our budgeted quantity, 10,000 units. Not so all are the standard profit, which we calculated earlier on as 5 CD 19 pesos. So this one, the standard profit was for 5 CDs 19 pesos. Then when we come to fuel pump, which is gas pump, sorry, gas pump, I have a quantity of 13.5, but the standard quantity or budgeted quantity is actually what? 13,000 units, right? Then you multiply by the standard profit. Diesel pump, the same. So diesel pump, it was what? The actual quantity was 8.5, but we were selling, we were budgeting to sell 9,000. So we can just multiply by their 19.5 and 32.5. So 19.5 standard profit and 32.5 standard profit. So what then do we get? So we have 9.5 minus 10,000 all times 5.9, 5.19. That gives us 2,595 adverse. Then we have 13,500 minus 13,000 all times 19.5. And we have 9,750 favorable. And we have 8.5 minus 9,000 all times 32.5. We have 16,250 adverse. Okay, so when you put all together, this gives you a total sales volume variance, which will be broken down now into the sales mix and sales quantity. Okay, just like mix and yield. So when I put this together, I have what? 16,250, 2,595, 9,750. End up with 9,095 adverse. So the sum of our mix and quantity variances should give us 1995, right? So since we know mix and quantity, I told you you do your what? SQ, AQ, AQ, right? Then you move in the opposite direction. So in that case, you put here SM, SM, and AM. And these are the only variables you're actually going to find in this kind of questions. So once I've done this, I rearrange because I'm doing sales, right? Sales means that you go in the opposite direction. So you start from the last because you go in the opposite direction. For sales, actuals come first. So actual mix, right? And actual standard mix, standard mix, right? So we know between this and this, the quantity are the same from here, but the mix is different. So this is the mix variance. When you come between this and this, you can see that mix and mix are the same, but the quantity is different. So this gives us the sales quantity what? Variance. Now that you know this, you can rewrite them. Okay, that sales quantity, the sales quantity variance will give us what? That's the actual quantity standard mix minus our standard quantity standard mix, right? All times the standard profit. And we know their standard profit, right? So all we have to do is just put there for oil pump, for gas pump, and for diesel pump, right? That's all. Then you go to mix two, come to sales mix variance, come to sales mix variance. You go, you look at your formula, mixes between this and this, right? Actual. So that means you have an actual quantity, actual mix minus our standard, our actual quantity at standard mix, not so, or at our standard profit. Okay, so you put there for oil pump, gas pump, and diesel pump, right? So all you have to do is now go and get the three variables that you always need to find. Your actual quantity at actual mix, Here, let me start with standard. Standard is the first you always have. So standard quantity at standard mix. Then you work that one. Now, what was the standard mix? How was it mixed in the standard? Now, they didn't tell you, right? Sometimes they will tell you how the standard mixes, but this question didn't tell you. So you pick it from the sales values you have here, the sales quantity. So the standard mix, when I take oil pump, when we sold 10,000, we expected to sell 10,000 units of what? That's a budgeted, right? We expected to sell 10,000 units of what? Oil pump. We expected to sell 13,000 units of what? Gas pump, and what? Um, 9,000 units of what? Diesel pump. When we add this up, right, that should give us a standard quantity, standard mix, the total standard quantity. And that will give us what? That's 10,000 plus 13,000 plus 9,000. That gives us 32,000. So look at how we get the standard mix. So it becomes 10,000 out of 32,000 for this guy, which becomes 10 out of 32. No, so this becomes 13 out of 32, and this one becomes 9 out of 32. So we got a standard mix. Now the next thing we need to do is to get our actual quantity at actual mix. So when you want an actual quantity at actual mix, there's the husband, there's the wife, right? So what's the actual quantity, actual mix? It was given. So I told you actual quantity always at the actual side is always at actual mix. No, so oil pump, the actual quantity was 9,500. Gas pump, it was 13,500. And then diesel pump was what? 8,500. Now, when you add all this, what do we get? That's 9,500 plus 13,500 plus 8,500. That gives us 31,500. Now, this 31,500 is the actual quantity at actual mix, right? This is what we're trying to find. Now, this is what we are now going to spread in the standard mix. And we've already got our standard mix, right? So that's the last variable, which we always find, which is actual quantity, the wife bearing the man's name. Also, so now I take my 10 out of, I take oil pound, is 10 out of 32 times what's the total I had? This was 31,500 times 31,500. If I take gas pump, that was what? 13 out of 32 times 31,500. And then diesel pump, I take 9 out of 32 times 31,500. So what becomes the figures that we need for this? We have 10 over 32 times 31,500. And that is 9,843.75. So let's make it 9,844. 9,844. I'm just rounding off, right? 31,31500 by 13 over 32. You end up with 12,797. Okay. And then the last one, 9 over 32 times 31,500. You end up with 8,859. Okay. I've just rounded off, though we are not supposed to round off. I've rounded them off. So we've got all the variables we need. So we can put it in our mix and we can put it in our quantity. So when I come to mix here, it said actual quantity, actual mix. I can just put in my 9,5. Also, can now put in my 9,5, my 13,5, and actually my 8,5, right? Actual quantity, actual mix. Now I need actual quantity as standard mix, which I just work to get. That's 9,844. 9,844. Then when we come here, it's 12,797. 12,797. Then the last one was 8,859. 8,859, right? So once you have this, you just have to multiply by the standard the standard profit that we have 5.19. So you multiply by the standard profit you have 5.19, 19.5, and then 31.5 or so. I think so. 32.5, sorry. 32.5. Okay. So now that you have this, you can get what your sales mix variance. So what do you get for sales mix? That means you have 9,500 minus 9,844, all at 5.19. You have 1,785.36. Adverse, the same way you have 13,500 minus 12,797 times 19.5. And that gives us 13,708.5. 13,708.5. Favorable. And you have 85 minus 8,859 all times 32.5. That gives us 11,667.5 adverse. So when you put out the sales mix variance, when you add them up, you end up having 1785.36. That's 13,708.5 plus 11,667.5 adverse. You end up with 255.64 favorable, right? So the same way when you get to your quantity, you're just going to pick your figures. So actual quantity standard mix. So we have them 9,844, 9,844, 12,797, and 8,859 or something. Yes, 8,859. So now we need our standard quantity at the standard mix, which we already have. So standard quantity as standard mix, we had it as 10,000, 13,000, and then 9,000 from the question. Also, so all we have to do is just close up for each of them: oil pump, gas pump, and diesel pump. So we just multiply. This one was 5.19 standard profit. This one was 19.5 standard profit and 32 cedis 50 pesos for standard profit. So you just get your figures. We have 9,844 minus 10,000, or at 5.19, an adverse variance of 809.64, 809.64 adverse. Then you have 12,797 minus 13,000, or at 19.5. And that gives us 3958.5 adverse. Then you have 8859 minus 9,000, all times 32.5. You end up with 4582.5. Also adverse. So when you put it together, all the quantity variances, sales quantity variance were adverse. We have 809.64 plus 3958.5. Then we have 45 82.5. So this gives us total adverse variance of 9350.64 adverse, right? So we've got our quantity variance and we've got our mix variance. So we have sales mix. So sales mix gives us 255.64 favorable, and sales quantity, which we just got, was what? Was 9 something, 93 something. Yeah, on my calculator, it says 9350.64. Yes, it may literally be, but that one was adverse, right? So when we put it together, they should give us the what? The sales volume variance. Okay, so that is this minus 255.64. We end up with 9095 adverse. And so when we check our sales volume, it should give us 9095. Did we get 9095? Yes, we did. So you see this 9095 and this 9095 are all equal. Sales volume 9095, 9095. So that's how we deal with sales mix variances.